They're coming. Tax changes, that is. On this week's program, we're going to be joined by our fellow certified financial fiduciary and CPA here at Nelson Financial Planning, Kristen Cayley, to talk about what's brewing in the Washington pot and what you can perhaps do about it between now and when those higher tax rates hit you. So she's going to join us on the program to talk about that. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. I guess tax changes would certainly be one of them. That is for sure. My name is Joel Garris. I'm a certified financial fiduciary, certified financial planner at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you this week change your life with a successful and cost-effective financial plan. So this past week, we had another successful client event. As we were talking about those last week on the program, we, during the course of the year, have these dinner sessions that are quarterly in nature. So every 3 months, we're having an opportunity for our clients to gather together, usually dinner and drinks and that kind of thing. But more importantly, although maybe not more importantly than the drink part, anyway, more importantly, it's an opportunity to hear from senior investment personnel, whether they be economists, tax people, folks that run a mutual fund. Those kinds of things are all folks that we bring in to educate our clients so that they have an understanding of what it is that they own from a financial and retirement perspective. So last week on the program, certainly you remember on the program last week, you wound up having a conversation. We wound up having a conversation about those principles of long-term investing resilience, and so that was sort of the topic. And so, if you're interested in catching that or reviewing that, feel free to check us out on our various social media platforms, whether that's Spotify, iTunes, even YouTube. Now on YouTube, you'll notice something different on this week's program. We got a cool little backdrop. So like when we do the show, I don't have to like take pictures off the wall or something like that. That now we've got a little backdrop that has like our logo and all that kind of stuff. So hey, we're adding to the production quality, if you will, of the program, particularly over on YouTube. But again, the topic last week and the week prior, because if you recall, we divided up those group client meetings over 2 nights to do the same thing so that we could kind of have more spacing, things like that, a smaller crowd and a larger venue, if you will. And so those 8 principles of long-term investing resilience, we encourage you to check out last week's program if you missed it. The other news of this past week certainly was the Federal Reserve, and particularly we saw a market that was beginning to react to some of those big changes that the Federal Reserve is about ready to undertake, right? At Monday, certainly a big sell-off day. 1 point down, the Dow was down over 800 points, but then lo and behold, Tuesday, Wednesday happened, and at one point on Wednesday was back up over 800 points. So a couple of words on that. First of all, remember perspective. And I think a lot of people are still think about point changes in indexes like the Dow from a perspective of 30 years ago or maybe even 40 years ago. And the reality is that the magnitude of the point change doesn't really make as significant of an impact as it did 30 or 40 years ago. Because the reality is when the Dow's at 35,000 versus when it's at 10,000, the 1,000-point drop or an 800-point drop doesn't mean the same thing, right? I mean, if the Dow's at 10,000, it drops by 1,000 points, that's a 10% drop. If the Dow's at 35,000 and it drops by 1,000 points, that's only a 3% drop. So it's really important to sort of measure or gauge things with respect to percentages to get a better feel for exactly what's going on in the market. So, but certainly this past week, certainly some reaction as a result of the Federal Reserve. They met this past week, they had their announcement, they had their conversation, and they finally recognized what pretty much every American already knew, and certainly something that we've been talking about at length on this program for 6 months now, and that is the fact that this inflation thing that they really hoped was transitory in nature, well, maybe it's not. And so they started the conversation about how do we then get to the point of starting to have higher interest rates, because one of our stated goals as the Federal Reserve is that we don't want to see inflation over 2%. Well, it's running at 5, some would even say 6. So that's a little bit more than 2 if you're doing that math. And so they have started the process of how do we unwind all of this easy money that we've put into the system. And understand that there's 2 ways that they do that. They do that through bond purchasing and ultimately interest rates. So they've cut interest rates to 0, and they're in the bond market to the tune of $120 billion per month, buying $80 billion worth of treasuries and $40 billion worth of mortgage bonds to help drive interest rates down as low as possible. So the first step is for them to start to taper that. And so what they said was, we're going to start to taper that so that by mid-year next year, we won't be doing any of that in terms of being in the markets and using our fiscal fist to ultimately drive down interest rates. So if you kind of run the numbers, they're going to temper that off by $10 billion a month on the Treasury side and about $5 billion a month on the mortgage side. That's how you wind up getting down to 0 in terms of the ultimately what they would be not doing, or getting out of that process of being in the bond market to help purchase bonds to help drive interest rates down. So that's part 1, if you will, and it now seems like they're fully committed to do that. The other part is raising interest rates, and here's where things get really interesting. Remember about 6 months ago, sort of beginning of the year and maybe even into the second quarter of the year, it was readily apparent that they were of the view that they were not going to raise interest rates until 2023. Well, guess what? Now you have half of the federal officials, so 9 out of 18, now on record saying, we think we're going to have to raise interest rates by the end of next year. So that will certainly create some reaction in the market. It will certainly get people's attention, and it certainly had an impact during the course of this past week in terms of the volatility in the market. Understand what's happening out there. The reality is we're sort of at an inflection point in terms of interest rates, or we're getting to an inflection point in interest rates, and that certainly gets a lot of attention from folks across the board, particularly the markets, right? When the economy is full of cheap money, that's always good for the economy and for spending and all those kinds of things. But ultimately, as we are seeing right now, too much of something can be a bad thing. And that too much is ultimately creating a level of inflation that they're now going to have to readdress. And so that's where we're at in terms of the interest rate story markets. Certainly one that continues to bear watching, which of course we will do that on this program. In the meantime, we're going to take a break. When we come back, I've got a couple of stories from the front, if you will, that we really want to share with our listening audience. So stay tuned for that here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. We've got a couple of what I would say as stories from the front. If you listen to this program in its entirety when it's coming out over the radio airwaves, you'll hear the commercials that we are running these days. And we talk about people overpaying for underperforming advice. And we really do think that that is a pretty significant issue in the financial services industry as a whole. And that's why it's so important that investors should know exactly what they are paying. And what's happened is, over the course of the years, the financial services industry always like to kind of stay one step ahead of the investing public. And the biggest thing that they've done is they've sort of bifurcated various costs and expenses. And so it leaves investors and clients not really understanding exactly what they are paying for. And so we're going to give you two stories from the front. And here's the thing, and the reality is that both of these stories hit on the same day this past weekend. It's one of those things where, every week we're thinking of what we can talk about on the radio program, doing a lot of preparation work. Certainly the team at Nelson Financial Planning constantly giving me articles and things to really kind of talk about, so that every week we can come to you with a new and exciting and informative, hopefully, show. And these two stories coincided on the same day within like the space of 2 hours. And I'm like, this is something we got to continue to bring up on the program. It's important to know your expenses. The notion of what's going on in the industry, to bifurcate the expenses, to have those be a separate subtraction or a separate invoice. And you forget that there's two parts of it, because that might be one part, but then there's the expenses of the underlying investments themselves. So let's begin with story one from the front lines of dealing with folks that ultimately come to us for help on a regular basis. So here's story one. This involves a large brokerage firm. Obviously, we will not disclose the name of said firm, but it's a big one. And the discussion that we had with this individual, when we were reviewing the statements that he provided, we discovered, and he did as well because he actually didn't know, that he was paying a cost of 2% per year, not including the expenses of the underlying investments that he had, just a straight cost of 2% on top of the expenses of the underlying investment. And so we're sitting there talking, going through it, and I'm looking at the actual numbers, and this gentleman had no idea that he was paying that. And the guy who was his advisor had been a friend for like 20 years. And so that was part of the conversation. He's like, I was coming here to just kind of have you check in, take advantage of, sort of the free consultations that we offer when folks come to Nelson Financial Planning for a conversation. And I just wanted to kind of take an eyeball on it. And we were talking about it. He's like, oh, this has been a friend for a long time. And, and the reality is he just didn't have any idea. So he leaves. And he calls said friend at large brokerage firm, and he says, hey, buddy, old pal, how much are you charging me? And the guy took a minute and looked it up and said, oh, we are charging you 2%. So now it's confirmed from the source that it was 2% per year. And here's the crazy thing. The guy then says, oh, let me reduce that down to 1%. Let me take the 2 down to 1. So the individual that visited me was calling to say, hey, thanks for saving me $10,000 a year. And I said, well, that's great. I'm happy to do that. Always happy to help. Just good business, and whether or not that individual becomes a client or not, I mean, that's fine. We understand long relationships, but I guess it underscores the point of, you better ask that question, okay? Because here we have an individual, 20-year relationship, and even the person that he was working with was surprised that it was still at that high of a level, and then proceeded to instantaneously reduce the cost, saving this individual $10,000 a year in costs. What's significant about that is he didn't know. Clearly he was being overcharged. Bottom line, at least he got some savings thanks to a conversation with us, so that's good. But at the end of the day, as I was, we were kind of wrapping up the conversation, I said, maybe you should ask for a refund for like the past 2-3 years or so, and then you could have gone and gotten, like a new car with that. I mean, at the end of the day, I mean, that's the kind of dollars that we're talking about. So that's story one. That's pretty significant, don't you think? Here's another one. Story number two. Again, stories from the front of why investors need to understand what their costs are and how all of the costs associated with any type of investment advice that you're getting are in fact being charged. Here we go. This is another large firm. This is a commonality in a bunch of large firms, right? The charge was 1%. Okay, all right, reasonable. But the account was sitting 30% in cash. Okay, wait a minute. And this one had an invoice. This was one of those invoice ones, right? So here's the invoice. We look at the invoice with her. It shows the charge. It's showing, the 1%, so it's 0.25% per quarter. And it's calculating based upon the value of the accounts. And it's showing the full value of the accounts. Meanwhile, we're looking at the actual statement. And the actual statement shows that you're 30% in cash. And it wasn't a situation where, they were going to move that money, they were going to trade that money. The account had not changed in years, folks. So it wasn't like they had just sold something and maybe they were sitting in cash and they were going to buy it. No, account had not changed in years. Getting charged 1% on an account that had 30% in cash. That's just not justifiable in any way, shape, or form, in our opinion. Getting charged that amount of money on cash just does not make sense. Two stories from the front, all hitting within just probably 3 hours this past Monday, that we wanted to take a moment and share with y'all, because as much information is out there, as much conversation is about what investors are being charged, the industry does a great job at really trying to hide the ball. So bottom line, make sure you ask that question this week of wherever it is that you're doing business with, to get a handle and an understanding on exactly what it is. And don't let them just tell you one part. There are two parts. There's the part you pay, and there's the expenses of the investments themselves. Make sure you're taking those two parts and adding them together to come up with your total costs. At the end of the day, if that number is more than 1.5%, expenses plus the fee, you're paying too much. Period. End of story. Make sure you're checking into that. Make sure you're adding it up and have a good handle on what exactly those expenses are. All right. We'll take a deep breath. As you can see, I'm kind of fired up about that because I don't like seeing people getting overcharged or charged for things that there's no way they're ever going to make money, right? You shouldn't charge 1% on cash. It's ridiculous. We're going to go to another topic. And we're going to bring in our associate, Kristen Cayley, our fellow certified financial fiduciary at Nelson Financial Planning, CPA as well. Hopefully I don't get that riled up on the next topic, but I fear I might, because it's taxes. And it's the changes that are percolating in the Washington pot of poo that ultimately is going to affect every American. I don't care what they say. Taxes have a tendency to get passed on to everybody. So we're going to be talking about that on the next segment of the program. There's a lot of speculation, a lot of conversation about what some of those tax changes are. I think we're starting to maybe see what they might be. Understand that all of this is still proposed, but it's important to say, wait a minute, if the writing's on the wall and there's maybe some things that I can do now to help, maybe I should do something about it, right? So we're going to do that coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Where where that winds up being at. So that's a pretty significant difference in terms of the tax changes that happen on that have already happened, that we're already seeing. So what else? What else is part of the conversation? Something about charitable stuff. I mean, where are we on that at this point? I think there was a change on that too.
Right. So a lot of you may have seen last year there was an above-the-line charitable deduction. So essentially what that means is if you don't itemize your deductions, you were still eligible to take a charitable deduction. So for last year, it was limited to $300 for single and married filers. For next year, it's going to be limited to $300 for single filers and $600 for married filers. So a little bit of an increase for married filers, but that's a good way to write off some of your cash donations. It only counts for cash donations, not physical donations like Goodwill sort of donations. But it's a great way to just give to some of your favorite charities and get a tax deduction for it.
Regardless of whether you itemize or not, that's a front page deduction. Okay, so those are the big two. The Advanced Child Tax Credit, which is basically sending money out each and every month to families with children, assuming they're below a certain income limit. It's based upon 2020, not 2021. So if your income goes up for 2021, you may be stuck with the surprise of having to pay it all back. That wouldn't be good. And ultimately, that the way that you sort of true that up is on the 2021 tax return. So all of that is the law. All of that is etched in stone. And for the Advanced Child Tax Credit, they're actually thinking about expanding it for another couple of years. Okay, so that is set in stone. That's established tax law. So let's now go on to sort of the more speculative stuff, if you will. Things that have not passed, but writing kind of on the wall a little bit. So let's break those down. I guess we would start with income tax rates. So what's going to happen on income tax rates? Again, as we understand it as of today, and obviously that can change a lot, but where are we as we understand it today?
So what's floating out there right now is that the top income tax rate is going to jump from 37% up to 39.6%. And also what's floating around is the income thresholds are going to lower. So people that were in that 37 tax rate are going to jump up to the 39.6. But also those that were in the second highest tax bracket, the 35%, may also jump up to 39.6%. So you may have been in one of the second to highest tax brackets before, and you'll be in the highest one now based on these income thresholds.
So those thresholds, they're shifting them down to pick up lower levels of income at the highest possible tax rates. Okay. So what's also the suggestion about going away from more of the flat tax versus the graduated tax structure? Tell us a little bit about that.
Mm-hmm. Also, so on the corporate side, that's what they're kind of thinking about, is going from the flat 21% up to a graduated rate that goes up to 28%.
So that's a pretty significant shift for corporate America as well, going from 21 to 28. I was reading an article just this morning that said 28 would put us back at the highest rate among the developed world in terms of corporate taxes. So what else on the income side of things that we're looking at?
Yes, and kind of along those same lines, the qualified business income deduction, that offset pass-through income, they're proposing that be limited to $500,000 of a deduction for married filers. I believe it might be $400 for single filers, but they're just looking to limit that in correspondence with the lower corporate tax rates.
So that what you're talking about there is the qualified business income deduction, and that was a deduction that allowed you to write off 20% of the profit of the business, that sort of normalized for the small business owner, normalized their effective tax rate versus the large corporation tax rate. So to kind of normalize those. So if they're going to change the corporate tax rate from 21 to 28, then they're going to adjust that accordingly. So everybody's sort of on the same footing. So what can you do?
Well, there's a couple things. I think we'll touch on that in the next segment.
Very good. We will do that. We're going to take a break. When we get back, we're going to talk about what you can do in light of these potential changes. We'll also talk about some of the potential changes that have to do with your capital gain tax rate as well. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So welcome back to the program, ladies and gentlemen. On this week's edition of Dollars and Cents, this is Joel Garris of Nelson Financial Planning, joined with me by fellow certified financial fiduciary Kristen Cayley, who also happens to be a CPA. So we're talking some taxes as well. In the prior segment, we were talking about some of the changes that are on the table in the Washington pot of poo. I kind of like that expression because it's pretty accurate, right? And we talked a little bit about what those changes might be. Now, let's talk about what individuals can do to sort of plan ahead, and what are some thoughts on that?
Yes. So when it comes to those income tax bracket changes and tax rate changes, there's really two things that you can do. You can accelerate income to be recognized in 2021, and you can conserve and save your deductions for 2022. So kind of the reasoning behind that is when the tax rates are lower, you might want to accelerate some of your income to be recognized in 2021. So that could be a couple different things. So if you work with contracts, maybe having them be established in 2021, maybe accelerating some of your income. If you have stock options that you can exercise, it might be a good idea to do that in 2021 before the end of the year. And then on the other hand, so when it comes to the deductions, so if you itemize your deductions, you take charitable deductions constantly, it might be a good idea just to maybe conserve some of those charitable deductions and wait until 2022, because once those tax rates go up, your deductions are going to be more valuable to you.
And then that certainly would interestingly relate to real estate taxes as well, because that's one of the things that they're saying, oh, well, they've got the SALT limitation, which is the limitation that reduces your ability to deduct income taxes, real estate taxes to under $10,000. That's one of the things that they're potentially eliminating, or potentially looking at eliminating.
Right. It's certainly on the table. So if that cap at $10,000 for your state and local tax paid, if that gets eliminated, you could really just pay your 2021 taxes early 2022 and be able to write off a bigger deduction.
Correct. And so that's really what we're talking about when we talk about timing of deductions and when you're writing things off. And then same thing with recognizing income. Now, it seems like that these income tax changes will be effective January 1 of 2022. So not retroactive.
Right.
In contrast to the other category, which is capital gains. So tell us what's cooking there.
So the proposal that's out there is any capital gain after September 13th may be taxed at a 25% long-term capital gain rate. So they're looking to increase that top rate from 20% to 25%, and they're looking to make it in effect as of September 13th.
Now, it's funny because in the proposals, they've been certainly talking about this increased capital gain rate. And so that's one of the themes that we've certainly been talking about on the program over the course of probably the past 6 months is, look, if you're going to incur the capital gain, you got to do it now. You got to do it sooner, because it wasn't that long ago when they were going to make it retroactive to like April or something, right?
Right.
And so they've pulled away from that at least, but it's still going to be retroactive to September. So if you were paying attention to the show and had a capital gain and did it this summer, then you're probably good, because they're not going to go all the way back to April now. So at least that part has changed, but you still have to deal with the fact that it is September. So what are some of the thoughts there? What are some of the suggestions there for people to be sort of thinking about?
So even with the earlier proposals, just maybe consider installment sales. That would break up your capital gain between multiple tax years. So under the new proposal, this top rate of 25% would kick in for single filers with taxable income over $400,000 and for married couples with taxable income over $450,000. So it could apply to a large range of people. So if you're able to break up those capital gains and recognize them over a couple of years, that could keep you in one of the lower capital gain tax rates. But it all depends on the type of transaction. Another idea would be to harvest your capital losses. So if you have some capital losses that are floating out there, it might be a good idea to offset some of your capital gains with those losses when the tax rates are at a higher rate.
Correct, and obviously that requires you to look at your positions in your accounts outside your retirement accounts to really kind of see where those are and where those potentially might be. A lot of folks these days probably don't have a whole lot of that built in, simply because of the upward trend in the market of late. But certainly important to be aware of the opportunity to be able to do that. Now, I guess this current proposal is a little different than what was previously floated. So tell us a little bit about, kind of how that has changed a little bit.
Right. So the previous proposal was that capital gains over $1 million would be taxed at your ordinary income rates, so whatever tax bracket you fell into. But that was just the marginal amount that was over the $1 million capital gain. So now it's just if you have income over $400,000 or $450,000. So that's a pretty dramatic increase in
terms of what could potentially get captured.
Exactly.
Yeah. Wow. So those are sort of percolating out there. We'll see, where that goes. What about the notion of the step up in basis? There was conversation about them looking to potentially eliminate that. And again, how that works is, when somebody passes away, the basis for tax purposes would traditionally, and this has been the law for like 100 years, would step up to the value at the time that they passed. But that meant that all of that appreciation that happened in one's lifetime would never wind up being taxed. So that was clearly something that they were looking at quite extensively. Where are they sort of on that at this point?
So all that's still up for speculation. What they have been proposing is reducing the unified credit of the amount that you are able to gift out or are able to leave to your beneficiaries. They're trying to reduce that from 11.7 million per individual down to 5 or 6 million per individual.
And that would be a pretty significant, and that also ties in with the estate taxes as well. Because that unified gift and estate means that's the same exemption, whether it's gifting during your lifetime or whether it's assets that you leave behind once you pass away. So that's why it's referred to as that unified amount. Mm-hmm. So that would be a pretty significant difference.
Right. And kind of what's floating around, like you said, the step up in basis. They're thinking about having that taxed to the estate versus to the beneficiaries. So some of that's floating around. None of it's really been confirmed. It's all speculation.
Yeah, and I did read where, some of the step up in basis, some of the more centrist folks in Washington are kind of resisting that. Or trying to figure out ways just to sort of limit that. So again, that's a pretty significant issue. It really does seem like the theme on a lot of these tax changes, well, there's really two themes, right? So high income, okay, we're going after that. And the other piece is really we're going after beneficiaries. We're going after people that inherit money and trying to figure out ways to tax them where before that that might not have been the case. So an interesting kind of themes that are sort of playing out. So we've got a lot more that we need to talk about in terms of getting out some of these tax changes. So care to join us next week?
Sure.
All right, perfect. So we'll do that. In the meantime, we want to wish you all a great Sunday. Thanks for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.